Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, you need to protect your investment. The experts at Building Insurance and Risk provide you with multiple offers and a side-by-side coverage comparison. To learn more, go to buildinginsuranceandrisk.com. Today, my guest is Paul Neal. Paul is the founder and principal funding strategist at Vantage Point Commercial Capital, a firm that focuses on helping entrepreneurs and real estate investors win by funding their growth and dreams in non-traditional ways. And in just a minute, we're going to speak with Paul about how and why to own the building your business rents, and for less than you'd think. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Paul Neal. Welcome to CRE PN Radio.
Hey, Darren, thanks for having me on. I'm excited about having a conversation today.
Well, I'm looking forward to it myself. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, sure, absolutely. So I'm a serial entrepreneur by nature. I started my first business while I was in college in 1988, and I'm now on my seventh business, and I've had a pretty good run of it. I've had some really great successes, had some failures. And so I've sort of lived the entrepreneurial's life, and so I've always had a sort of a vision and a dream to, live the life that I've sort of carved out. And I know a lot of real estate investors and business owners were all sort of cut from that same mold, and we fly, to the sound of a different drum beat. And so I've always endeavored to do that, and it's been a great ride, and I've learned a lot.
That's great. That's a lot of different entrepreneurial ventures there. Seven ventures, and like you said, if it's in you, it's in you, and so keep going there. So let's talk about our topic today, essentially owning versus renting for business owners. And I guess the first question I would ask is why business owners should own the property they operate from as opposed to rent.
Yeah, that's a great question, Darren. The short answer is that they shouldn't all necessarily do that. I mean, it depends on the situation, the circumstances. So, the world has changed a lot, particularly in the last couple of years. And so some businesses are always going to be sort of in a market, a community. They're going to have a community presence, and it's going to require a physical presence, right? So that could be your dentist, your veterinarian, could be your HVAC company, your plumbing company. There's a litany of companies that are local and require, maybe it's manufacturing, something like that requires a physical presence. And then there are a litany today that don't require that. With the technology we have today, we can have a distributed workforce and, a lot of flexibility there. So it's really very interesting time, and there's great opportunity. I say if you fall into the category one business where you have a physical presence and you're in a community and your intent is to be there for the long run, and you've had a pretty good track record. I mean, you've got a business that's doing well. You don't, it's not falling apart. It's growing. It's stable. Then owning the business, the building makes total sense. And a lot of people sort of push back because business owners, they don't realize they can do it. The barrier to entries generally are higher. But if you frame it in the context of like the residential space, most people own their own home. You have to live somewhere. So you're going to either pay rent or you're going to pay a mortgage. And there are certain benefits. Obviously, most people choose to buy the home that they live in for a lot of reasons. And a lot of those same reasons apply to the commercial space. And we can get into the, what those are. But if it makes sense, then again, a lot of people just sort of pass it off because the barrier to entry seems high. And in some cases it is, but in many cases it's not nearly as big as most people think.
Yeah, I get it. And I've always been kind of curious why so many larger companies, excuse me, look to lease space. You find all the time opportunities to buy a Walgreens physical location and lease to them. And so I would love to hear more about kind of why, why you think it's or why it's a good idea. I mean, to me, it makes sense, but I'm kind of curious, maybe even more, why some of the larger companies look to lease space.
Yeah, that's a good question on that. And I'm not sure I have a definitive answer on the Walgreens of the world. I actually have some clients that do what you're talking about. They buy and build and buy the building and then lease it out to Walgreens as a single tenant or whatnot, have done well there. I'm not sure if that's the capital requirements or why they're making those decisions, but I do deal mainly with the smaller mid-sized company that is owner occupied. They're in the $1 to $30 million range in terms of revenue, and these are locally present businesses that again, there are a litany of reasons why you'd want to do it. I'll give you a few. So what we see, I'll give you some examples. So the first one is control. You look at the economy that we've been in, we're now in an inflationary environment, rents are going up across the board. Landlords have control there. And so I had a client who owns a couple of pizza businesses, restaurants, and he's renting the spaces. And one day earlier this year, the owner came to him and said, "Hey, we're going to sell the building." And so he spent 8-9 years building this location, put, I think, 60,000-70,000 into the kitchen to get it just the way he wanted, build it. And it's a locally clientele business. I mean, if he moves 4 miles down the road, I'm not sure how much of his clientele he's going to lose, but a pretty good amount. And so there was no guarantee that the new owner was going to allow him to stay. It wasn't going to repurpose it for something else. And so we worked with him to buy that building. So now he has control. He makes the decisions on, whether he, moves or doesn't move or whatnot. So that's one great reason. In addition to that flexibility, you can do with the property more what you want. You can build it out the way you want, utilize it. Another great reason is there are great tax advantages to it, right? So owning that business, most of our clients will buy, they'll set up a separate company that buy the real estate, and then their business will basically lease from that company. And so they get the advantage of the depreciation in the commercial space to help offset some of that. And I'm not going to get a lot into that detail because I'm not a CPA, but there are tremendous tax advantages there. Another option or another benefit potentially is the rental income option. We see it on residential a lot. You see it in commercial, larger buildings, but a lot of our clients are buying building spaces that are larger than their needs. And so they're bringing tenants in to help pay the freight on that mortgage. So their net cash flow out is much less than they would have paid in just a straight up rent situation. We just did a refinance on a local warehouse where it was a roofing company, about a 10,000 square foot warehouse. They were in about 5,500 feet, and they had leased out the other space. They subdivided it, I think, into four bays, and the tenants are completely paying the mortgage. So you have other people paying, the mortgage on this commercial building, which is also appreciating over time. So he bought the building originally about 10 years ago. I think it was $700,000. We just had it appraised for 1.2, 1.3 million, and other people are paying for it. So not unlike your residential home, over time generally will appreciate, not necessarily year to year, right? But over time. And so that's another reason. How about this one? The ability to leverage your business if you're looking for other financing. If you have a real estate component in your business, as a lender, we look at that differently than just an operating company with rent. It's more like a blue sky company. It's a lot of goodwill versus tangible real estate. Another reason, how about a retirement income stream? We have a client, she's an OB-GYN, nearing retirement. She's about 4 years out. She just sold her business to a medical group that is sort of, buying up little independent operators with the intent of, hey, I'm gonna be retiring. I'm gonna turn this over. But the great thing about it is she bought the building that they operate her business in 15 years ago. The building is paid off. The new company that bought her practice not only paid her a nice sum for that, pays her to stay on as a physician, but also is paying a nice 5-figure rent to her and her family for the building because they don't want to move the practice. So a great retirement stream that you're developing at the same time. So there's a number of benefits there to actually, owning the building. I would say if your business is, again, in a risky situation and it's, your future is uncertain, probably not a good time to buy, your own building. But there are a lot of businesses out there that are very stable, very solid, that really, really could benefit by owning the real estate.
No, I like all of those. And a little foresight and a little planning, you can set yourself up well for retirement or beyond. I wanted to ask you a little bit about the challenges that business owners face when borrowing money. I know I've got multiple clients, and this has been a conversation, not a deep dive conversation, but I just know that a lot of times the banks look at them differently, kind of like as you alluded to, whether or not you have real estate on the books. Or what are some of the challenges that a business owner faces when borrowing to buy a property for their business?
Well, I mean, the three things that most banks will look at, I call it the 3 C's of lending, or collateral, cash flow, and credit. So if you go to the typical bank, then you have to be strong in all 3 areas. So your business has to cash flow well. It has to have a history of cash flowing well. Your credit has to be in pretty good shape. Most banks, everyone has a different guideline, but it has to be in pretty good shape. And then the collateral issue, most banks hedge their risk. I know we're going to get into risk a little bit later by limiting, the amount of money they're going to loan against the property's value. So we call that loan to value. Typically, a bank is going to want 20 to 25% down of your own money. So they're going to loan 75, maybe 80% of the value of the property. So that's generally the biggest barrier to entry that we see, because if you take let's say $1 million building, which is a pretty small office building today, we probably should start at 2. Well, hey, 20% of that is $200,000, and you might have that in your operating account. A lot of business owners do, but to take all that money out of your operating account and put it in real estate where it's now not liquid at all, right? You're not going to have access to that for a long time, is a tough nut to crack, so to speak. I mean, you got to think long and hard about wanting to do that. So those are typically, or maybe they had a bad year during COVID cash flow wise, and they're coming back this year, and so the cash flow is not, where it needs to be. So those are the biggest barriers that entrepreneurs face when they go to a bank. Now, there are programs out there like the SBA. Most people are familiar with them. They have more, I'll say, more relaxed guidelines in some of those areas. Like they'll generally go to a 90% loan to value or a 10% down. Their amortization terms are a little bit longer to help on the cash flow. They still have serious credit and cash flow requirements. But the thing is too, that a lot of people, every bank in America will say they say they do SBA loans, but the reality is they don't really. They might do once every blue moon. And the SBA is an awesome program, but you really have to know how to navigate the waters. There are a very few lenders in the country that are what's called PLP SBA lenders. And so PLP means they don't have to get the SBA to sign off on the loan. They make the decision right there and they fund it. So what happens is if you go to your local bank and they say, we're going to do an SBA loan, and this is why SBA has gotten such a bad rap over the years, the bank will underwrite the loan, but once the bank has you jump through all the hoops, then they have to send the loan to the SBA, and it's going to sit on some government bureaucrat's desk for some time. They're going to evaluate it separately, and then they're going to make it their own independent decision. So they could come back with additional conditions, or they could just, deep six it right there. So it makes a difference on who you work with. So certain of these preferred lenders can make the decision right there. So there's one less major hurdle to jump. Banks also have their own sort of overlays and requirements. So even if they say they'll do an SBA loan on a lower loan to value, they may have requirements on the cash flow of the business or the credit score, because the banks really, you're not their customer. It's the regulators, the bank, the board of directors. Those are the people, the masters that they have to serve, and they have portfolios that they, a certain portfolio that they want to fit certain loans into that mix. And so they've got their boxes you have to check and whatnot. So it depends on where you go. But then and then there are even some SBA lenders that will create a hybrid loan where there's a 0% down requirement. Based on the credit and the cash flow of the business, there's some opportunity there. So they're not all created equal. And what I find, Darren, is most entrepreneurs and business owners, when they're looking for a loan, they think, hey, maybe I'll buy the building or whatever. They talk to the banker that they have their deposits at, right? Because we're all taught to build a relationship with your banker. And and he's going to say, well, no, you need 20% down or 25% down, or we might could do an SBA loan or whatever. But they don't really know the market. They only know their little experience in the market because they're busy running the business, right? I mean, if you're an entrepreneur, somebody's got to run the shop, right? Or make sure that your people are running the shop. And so they have a very sort of myopic view of what's available to them. And so then they shut the door and move on. They're like, I don't want to take the $200,000 on my operating account. I had a cash flow issue last year or whatever. It's just not worth going into it. Or maybe they get an offer, but maybe it's not the best terms. Like, for instance, maybe the bank says, we'll do it, but we want your deposits. We are going to have some covenants. So we're going to review them every year. We can call the loan if we want to. Most SBA lenders, even the preferred ones, are variable rate lenders. So I think the average is a prime plus 2.5 loan. So if you did get a good SBA loan a year ago and you're at prime plus 2.5, your rate last year was 5.5. Now, when the Fed finishes the rate hikes in the next 2 months, they're going to come up another 75 basis points in November and probably another 75 at the December meeting. The prime is going to be at 7.75. So these loans are going to go from mid fives to 9.5 to 10% overnight, and that's a cash crunch. But there are a few SBA lenders out there that'll do a 25-year fixed rate. So we had a warehouse. A friend of mine actually is a client as well. He owns a small trucking company, and he wanted to buy a warehouse down here by the port because he had all kinds of customers that wanted to store. I mean, he had a great business case for it. Long story short, he was able to secure. He went to his local bank, and then we talked, and we got him a 25-year fixed rate. I think it was like 4.95. So, wow. And that was just earlier this year. So if he would have taken the loan at the bank, he'd be sitting at 10%, but now he's sitting at 4.95 for, 25 years. So it all makes a difference on, where you go, who you work with. And, and again, banks can be good. We do work with some banks, and we love community banks, but it doesn't always work. So those are some of the barriers. I think some of the reasons why business owners say no, or they don't want to pursue it, or, or maybe they're concerned about the future of rates and like, gosh, I don't want to be in a position where my payment could double in a year. And so they don't do it, and they just continue to pay rent. and the rent goes up every year, and 10 years go by, they've paid rent, they've locked into leases for 2 terms, and they've got nothing to show for it.
Yeah. No, the list of upside, and then kind of like you said, all the banking challenges. Um, it's going to take a little bit of effort for anybody that wants to do this. Um, but I'm curious. So, is Vantage Point? Are you guys a broker, a lender, or how are you guys set up?
Yeah, so we do a little bit of both. I mean, I really consider us concierge lenders. We develop a relationship. So we have a 4-step process with our clients. We want to source the market, but we want to be your partner. We want a relationship with you, Darren, over the long run, because if you're a business owner, you always have needs for capital, right? Not just today. Similar to your insurance business, you want a long-term relationship because the business's needs for insurance change year to year, right? Maybe you're looking for real estate this year. Maybe 2 years from now you want to acquire another location, maybe buy out a competitor. Maybe you're looking for growth capital. So, what we do is we get to know you. We learn about you, develop a relationship, and then we source the market. Sometimes we use some of our own money. Sometimes, but we use banks. We have life insurance funds, venture capital. We have family funds. There's a lot of options out there that we can draw from based upon the situation. And the situation is very fluid, right? I mean, look at what's happened in the last, this year to the whole financial world. And then but we're in a unique position where we then can sell you to the money sources because we're on your side. We're not beholden to any one particular board of directors or any one particular source of money. Our goal is to provide the best capital options for you. And then our third step in the process is to lay it out, to educate you, say, here's 3 or 4 different ways you could go about this. Have you considered these, and have a conversation and dialogue? And then if one of them makes sense for you, then we go into funding. So, and our thing is, again, we're a long-term player. We're not about a transaction. So we don't even charge anything unless we can actually provide the capital to the table and the deal closes and you get what you need. And so that's the way so we're not going to waste your time. We're not going to waste our time, but we're also going to try to do the best we can. And we're going to work really hard to make sure that we get your loan funded at the end of the day, if it makes sense for you. And if it doesn't make sense for you, we'll tell you. I mean, sometimes there are options like maybe you can't show any cash flow. Well, there are options there. I mean, we can do some asset-based lending, and that might make sense, but it might not make sense for your situation. Or maybe your business is a little, teetering a little bit right now, or maybe your market is changing a lot. We might say, let's talk about this. Maybe you should delay a year and see if this stabilizes, because you don't want to lock into a long-term commitment if your business is a little bit, unsteady or uncertain. But yeah, so that's how we partner. So you could consider us, I guess, a broker in a sense with some lending capability, but really it's more about a partnership.
Got it. And you mentioned some of the different sources. Are you guys an SBA lender, or do you find the SBA lender that fits the client's needs? Or
yeah, we've got great SBA lender partners. Yeah, we don't do those ourselves, but we have, like I said, based on the situation and what they're trying to accomplish. Because they're, even the ones we work with, there's no one great SBA lender. It depends on the industry. It depends on what you're trying to do. It depends on your history. Depends on how much leverage you're trying to seek. A lot of factors. So we have a portfolio of them. We have great relationships with, and we're always talking to new sources to try to understand, who is doing something new and unique and different in the marketplace.
Got it. And you mentioned you guys lend some of your own capital. Do you ever raise capital from investors looking to lend for return, or?
So in a loose manner, yeah, we haven't formally done that, but once in a while we'll have an opportunity and we'll kind of float it out there to some of our clients, because a lot of our clients have some free cash, and we can put things together. But we're not in the formal capital raising business. We don't have any SEC filings or anything like that.
Got it. And what's the territory of your operation? Do you stay local, or do you have any limits?
No, we're national. in some cases international, but mostly here in the US. We some of the state, New York is a little kludgy sometimes for us. There are a few states that are a little, we gotta pause before we make a decision, but for the most part, just about anywhere in the US.
Got it. And you mentioned kind of the interest rates are cooking up. Um, are you seeing that kind of narrow the opportunities for buyers right now, or sellers adjusting their sales price? I mean, because I'm assuming it's always about a payment at the end of the day. Is if you're borrowing money, the lender wants you to pay back the loan.
Right.
Wants to make sure you can afford the payment.
Yeah.
In these situations where interest rates are going from, low or fours to nine, based on what the Fed's doing. How are you seeing that change the dynamics of the marketplace?
Yeah. So putting a caveat on that, that's, that in the nines is that prime plus, SBA, but
Right.
we still see some money in the mid fives to sixes, and in the sevens, just based upon the type of product in the building. So it's not the end of the world, but there is some tempering for sure, and expectation on, the money's no longer free, right? And so, I mean, the Fed funds rate was, what, 1%, a year ago, or the 10-year treasury was 1%, a year ago. So now we're right at 4%. So it's not free, but the long end of the yield curve is still holding in a pretty good place. I mean, it is going to be interesting to see what happens moving into the first and second quarter of next year. I mean, the economy is slowing. And the inflation numbers that we see, which are driving the interest rates up, that's why the Fed's been so aggressive to push up the short-term rates, try to get a handle on inflation. We're going to see the November reports come out, and they're going to start to show some moderation in the right direction, because those reports are based on year-over-year numbers. And if you look at the last summer, not this past summer, but a year ago summer, the inflation numbers were still pretty low. And so when you compared this summer to last summer, the inflation numbers were really hot all the way through September. Now, once we got in October of 2021, those inflation numbers were already starting to show pretty good number. So the delta is going to be smaller. And so we're going to start seeing that number come down in a measured way. Now, we still have inflation, but that's going to ease some of the concern in terms of the Fed pushing the prime rate up. And if you look at the long end of the yield curve, again, those rates are still in the threes. And so the long-term expectation from sort of the global money world thinks that inflation is going to come in check, and that growth is going to slow down a little bit. And so how did that affect real estate? I think there are going to be some great opportunities. I think some sellers are going to want to get out. And I mean, we're starting to hear a little bit of it. I mean, I don't have any great stories right now saying, hey, they're slashing their price by 30% or whatever. I don't think that's going to happen. Interestingly, what we see on the residential side is there's great supply issues as well. I mean, there's very little supply. And so those prices are expected to remain stable and even grow, except for in a couple of markets, like your crazy markets, your Phoenix markets, and, all the ones that always go, way up and way down, right? The cyclical markets.
Boom and bust. Right?
Boom and bust, boom and bust. But what's interesting, like in the business side, we do a lot of business acquisition funding too. There are a lot, because the economy is slowing and we've seen the inflation and people's perspective is shifting. We see the silver wave, the older entrepreneurs and business owners that have sort of weathered recessions before, have done well. The last 15 years have been pretty good, particularly the last 5 or 10, and they're now wanting to sell. They're wanting to punch out. And so that also goes with the real estate. They're like, okay, we had a good ride. We're going to go, we're going to take our chips off the table and move on. So I think there's actually going to be great opportunity there from a buyer standpoint that we haven't seen in a while. Because, that's when people, what is it? Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. And so as the pendulum has swung, I think it's going to create opportunity. I mean, you have to be smart about it, right? And you have to be measured and not move on emotion. But I think we're going to see that.
Yeah. Hey, Paul, if we could, I'd like to shift gears here for a second.
Yeah.
By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk.
Mm.
And there's three strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, tenants, the market, political, interest rates, Fed, however you want to identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Paul Neal, what is the biggest risk?
Well, I think the biggest risk that business owners and entrepreneurs face today and into the foreseeable future is what I call big. Big government, big technology, big media, even big banks. We've seen it over COVID. It's been in our face that there's a movement to sort of aggregate the power up into the hands of the few. Again, whether it's government, media, big business is is a threat to small business and entrepreneurs because we're free agents. We're out there on the street. We're the ones that are building the community. We're hiring employees. We're caring about our customers, caring about our families, giving back to the community. We're the ones that want to be able to exercise, free and independent thought. And we have these forces that are aligned against us. And again, you look at COVID, who did they shut down? Well, they didn't shut down Amazon. They didn't shut down Walmart, but they shut down the mom and pop that had a coffee shop. They shut down the church. They shut down, anything that didn't sort of fall into this large monolithic group that could be controlled. And I'm not saying there's any sort of force behind it other than the fact that it's just natural, right? That we're sort of in a battle here that we all want control, and it's easier to control the smaller number of levers that control sort of larger economies. And without getting really deep and off that end, I just think that we're in a fight, and I think as entrepreneurs that for us to survive into the future, that we need to stick together and realize that I don't think our issues are, most business owners that I know, regardless of their color, their background, their creed, whatever, they just want to work with customers and serve people. And they want to do the best they can. They want to work in excellence. And we just have to stick together, and so we can all win together. Because I think when we win as entrepreneurs and business owners, our families win, our communities win, and ultimately society wins.
No, I love the we message. I feel like so much of what we hear is the me message, and definitely there's a bigger issue there. It's the we, and if we look out for the we, I think we've got a chance. So I appreciate that.
Yeah.
Hey, Paul, where can the listeners go if they'd like to learn more or connect with you?
Yeah, awesome, Darren. Well, I've got a website, and I actually have created a little resource for your listeners that they can grab for free. I call it the key questions that you must ask and answer before seeking funding. And it's just a tool to kind of think through the process. Again, because you don't jump right into funding. Hopefully you don't go with the online guy that's going to fund you in 5 minutes, because it's a bad decision. Think through the process. So that's going to live at our website. And our website is VPC Victor Paul Charlie .capital. There's no .com. It's VPC.capital podcast, and then a little dash or hyphen CREPN for your show, the CREPN.
Great. Well, Paul, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Hey, Darren, it's been a lot of fun. Thanks for having me on the show.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.